I think the transition is going as smoothly as could be expected, and I think where it's being shown up is in the anemic wage growth. So, GDP is growing at 2.5%, inflation's growing at 1.5%, unemployment's steady, but wage growth, basically we're in a recession as far as wage growth is concerned. And I think what's happening there is the transition. So you've got people that used to work in the mines and on oil and gas projects and things like that. A lot of the capital expenditure is now coming to an end. They're having to find their way into the other parts of the economy and take lower wages. So I think that's where it's showing up in the numbers. But as far as the actual, when unemployment didn't go up, and it hasn't been going up for about 2 or 3 years now, everyone thought that they were just a one-off statistic, and eventually you'd see this unemployment show up in the stats, but it just isn't. So people are finding jobs, new car sales are up, and so everything seems to be okay. And if you could just look at the numbers in the economy without the noise from, if you could just look at it in a bubble, you'd actually say things were going pretty well. But confidence is an issue. We had some political issues, I think, when Labor were there, and now the Liberals are sort of doing a similar thing. That could be impacting confidence. But I think the transition from resources to more industrial type businesses has been smooth, and in fact, who knows, the resource sector may be at the bottom of a cycle and could be in the scope for an uptick. I think that you have to look outside the top 20, and for instance, if there's been a lot said about index tracking, reducing the cost of your portfolio management, etc. If you track an index, you are buying 20 reasonably low growth businesses, and they're ripe for competition. So I mean, you look at Woolworths, for instance, with Aldi coming in, BHP susceptible to commodity prices. You got the banks. If housing prices start coming off, that'll impact the banks. They've been able to grow earnings by about 5% a year. A lot of that's come from, for instance, fixed income trading, and we know what they've been doing with the LIBOR rate now. So they're not going to get that revenue stream coming through. So they're the sorts of businesses that you buy when you buy an index tracking fund. And about 35% of the market is just the top 4 banks. So you've got that significant concentration risk. I think if you're going to manage your portfolio prudently, you have to look outside index tracking, even a core satellite approach, and index track a portion of your wealth and then actively manage another portion. But you have to complement it, I think. Otherwise, in the Australian market, you get concentration risk. In international markets, it's different because they're more diversified and they've got more sectors and exposures in their indexes.